All right, we are on chapter 3, and we're going to be covering the balance sheet and financial disclosures. Okay, so the balance sheet can be called a couple of different things. It can be called the statement of financial position, um, but bottom line is it's going to have the assets, liabilities, and equity in the balance sheet. Those are the type of accounts. Everything else is going to go on a different statement. Okay. And remember, the balance sheet is also dated different than all the other financial statements. It will be a 1 day in time, like a snapshot. I always refer to it as a picture. The other ones are dated like a movie, like you're looking at them from the beginning of the year to the end of the year, or beginning of the period to the end of the period. Okay. So here we have the asset section of Nike. And you see we have our current assets. Now, just quick little reminder, we have our current assets, long-term assets, current liabilities, and long-term liabilities. Okay, so this is just our assets. So you see that current assets, it's a really important number. Everything else is going to be long-term. Long-term has more than one thing in it. It's not just property, plant, and equipment. There's all these other things, goodwill, intangibles, deferred income taxes, and other assets, but those are all long-term. Okay. There's a lot of ratios that we use that we want to pull current assets and current liabilities because we want to see, can we pay our bills in the coming future? Okay. So here's the liabilities and equity. There's that current liabilities. We have our long-term liabilities. Those are long-term debt, operating leases, deferred income taxes, and other liabilities. Okay. Then we have our stockholders' equity section. We're going to have a common stock, additional paid in capital, retained earnings, and then we'll have this accumulated other comprehensive income. Okay. Balance sheet has to balance. If it doesn't balance, you did something wrong. Go back and do it again. All right. All right. So assets and liabilities are classified according to common characteristics. The grouping provides us useful information about liquidity, long-term solvency, short-term solvency, and a lot of other things. So it is a very useful statement. Okay. One of the limitations of the balance sheet is that we may have assets on that balance sheet that are not listed at market value. So I always use a piece of land as an example because land usually appreciates. And let's just say you bought it for $5,000 50 years ago and it's still on your books at $5,000, but it could be worth 1 million. Okay. So that's a limitation of GAAP financial statements. Okay. Because we don't allow market value being wrote up on those property, plant, and equipment type assets. Okay. We are under historical cost, and that's where IFRS and GAAP sort of divide out in each other. Okay. This is a big thing because IFRS actually lets you write up if that same piece of land, if you were using IFRS, you can write it up as $1 million asset then. Okay. There's a couple of other little things that go into that, but basically that's the way they do it with IFRS. Okay. I don't know which one's better. I mean, historical costs, we know that's a for sure number. Like we don't have to think about that. That's what we paid for it. So we know that's a good concrete number. Okay. And then some assets aren't even recorded on the balance sheet. Okay. You could have a really good, very educated workforce. There's nothing on the balance sheet that helps us put a dollar value on that. Okay. So, and you might have a really good name. Okay. That's usually where goodwill comes in, is if a business gets bought and it's bought for more than the fair market value of the physical assets, then you have goodwill. Everything else is goodwill. Okay. But the company creating the goodwill cannot record goodwill. Okay. So I kind of already did this for you. Up there, assets, liabilities, and shareholders' equity. We have two broad sections of shareholders' equity. Remember, there is kind of a third one. I hate to leave that off because you could have treasury stock there. Okay. And all right, I'm not going to do that little multiple choice question. Let's talk about a little bit more in depth on current assets. Okay, current assets are those assets expected to be converted into cash or consumed within the coming year or within a normal operating cycle of a business life. Okay. If it's longer than 1 year, some businesses do have a longer operating cycle than 1 year. So those are a little bit differently. But for the most part, it's 1 year. Okay. So we have the operating cycle here for a merchandising or manufacturing business. So we'll use cash to acquire inventory. A lot of times we won't use cash to acquire inventory. We will acquire that inventory on account and we hope that we sell the inventory so we can pay that bill back. Okay. But not necessarily does it have to be cash. We acquire the inventory, prepare the inventory to sell to customers, deliver it to the customers, then collect the cash from the customer, and then we start all over again. We buy some more inventory. Okay. And that's where businesses like Walmart and Target make lots of money because that cycle is happening over and over and over and over millions of times. Okay. Some of the elements of current assets, we have cash, cash equivalents, short-term investments, account receivable, inventory, prepaid expenses. Okay. Here we have a comparative year comparison of Nike and their current assets. And you can see their current assets was 28 to 13. These are in millions, of course. And it was a little bit lower. So our current assets are growing. And I guess it's okay if it's growing. I was kind of looking like it depends on what is growing here. Is our cash and cash equivalents growing? Our cash equivalents actually didn't grow. They kind of went down a little bit. Looks like probably the short-term investment is what grew quite a bit here. Okay. So, what is a cash and cash equivalent? Okay, it is something we can turn into cash really, really fast. Okay. The maturity date on it is no longer than 3 months from the date of purchase. Okay. This can be commercial paper, money market funds, U.S. Treasury bills, bank drafts, cashier's checks, money's orders, cash equivalents, and all of those things fit underneath that umbrella of cash and cash equivalents. Okay. Short-term investments. These are going to be investments in stock and debt securities of other corporations, not our stock. We have gone out and we have bought stock or debt securities in another corporation, and that's part of our portfolio right now. Okay. Very short term. They usually have the ability and the intent. Okay. There's two little things there, ability and intent to sell within the next 12 months of the operating cycle, whichever one is longer. Okay. Accounts receivable. This is sometimes called trade receivables. It is in the normal trade of business every day is when these receivables arise. Okay. Usually arise from the sale of goods or services on account. Any non-trade receivables, they result from loans by the company to individuals or other entities. Okay. Notes receivable, has to have a formal agreement or note that specifies payment terms. Okay. If the note receivable is less than a year, it is current. If it's more than a year, then it will be long term. Okay. Inventory is a huge part of a manufacturer or a merchandising business like Walmart, Target, a lot of money they have tied up in inventory. Okay. If we are a manufacturer, then we are taking raw materials and we're putting them onto an assembly line, what we call work in process. And then when they leave that assembly line and they're done, or the car comes off the assembly line, then it turns into finished goods. Finished goods acts very similar to merchandise inventory. Okay. Because when it leaves merchandise inventory, it turns into cost of goods sold. When it leaves finished goods, it turns into cost of goods sold as well. Okay. Prepaid expenses. Sometimes businesses will do this. They'll prepay rent, prepay insurance, usually to get a better rate. A lot of times coming up with all of that on the front end helps, you know, get them a better rate. That's the only reason they're going to pay it in advance. They're not going to pay it in advance if they're not getting any benefit. I know I had some students tell me one time, oh, just to say that bill's paid for. No, not necessarily. We don't do that in the business world. We're going to want a benefit if we're going to give you 6 months, a year of prepaid expenses. Okay. Supplies doesn't say prepaid on them, but supplies are a prepaid. They're a type of prepaid item. because we buy them, we put them in a supply cabinet. We don't necessarily use them right then at that moment. Okay, so they're not an expense until we use them up. Okay. Then we have long-term assets, okay? These long-term assets, it could be in investments, could be property and plant and equipment, intangibles, operating lease assets, other long-term assets. There's lots of things that are going to fall into this group of long-term assets. The building that's housing the inventory for Walmart, the warehouse for Walmart, those things are the long-term assets, okay? If you'll remember, when we're doing statement of cash flows, this is what triggers the statement of cash flows investing section. Okay. A lot of students get that confused because they think investing, they think stock and bond, but we're talking about our company investing. If we bought stocks and bonds in another company, yes, that is investing. Issuing our bonds and our equity is a financing activity. But here's what triggers the investing activities. Okay. Investments, these are not directly used in the operation of the business. We might have had some extra cash laying around. So we're going to put that in, maybe put that in an investment for, however long we need it. We can do that. Land held in speculation, we're just holding that land. We may sell it, we may not. Okay. And then any long-term receivables. Okay. Property, plant, equipment, these are directly used in the operations of the business. Okay. I often try to differentiate. So if you think about a farm has a John Deere tractor, that is property, plant, and equipment to that farmer. The John Deere tractor sitting on the John Deere lot is not an investment. That's inventory because that's what they're selling. Okay. So you've got to think as in take into consideration what it's being used for. If it is an inventory item that we are holding to sell, then it is not property, plant, and equipment. It's inventory. Okay. Think examples here: land, buildings, equipment, machinery, furniture, and vehicles, as well as natural resources, mineral mines, timber tracts, oil wells. All of those fall underneath property, plant, and equipment. Okay. Operating lease assets. Okay. There is a rental agreement giving a company the right to use an asset. There are periodic cash payments are required by the company. The asset is returned at the end of the lease. Okay. These are kind of key. We're going to go over in more depth on leases, but if the asset's returned, then it does look like it's a lease. Sometimes there'll be a bargain purchase. So like, okay, you're going to lease this from us for 20 years and then you're going to buy it for $1. That's a bargain purchase at the end. That's a financing agreement. That's not a lease. It looks like it might be called a lease, but it is a financing activity. Okay. And it has to be put in the accounts or in the balance sheet as that. Okay. Intangibles, these are those things that we can't really touch. It's more of a right. Copyrights, patents, trademarks, franchises, and goodwill. Okay. They're always net of accumulated amortization. Remember, accumulated amortization goes along with the intangible assets. You have amortization expense and then accumulated amortization, which this acts very similar to accumulated depreciation. Okay. Other long-term assets. Okay. This can just be a catch-all for everything else that's not reported separately. Okay. It could include long-term prepaid expenses. So like if we paid 2 or 3 years of insurance in advance, the long-term portion of that needs to be in the other long-term assets. The current portion that we'll use up would need to be in the current. Okay. Key to understanding which category an asset is reported is a management intent. So we have to look at what's management's intent with this asset as to how we're going to classify it. Okay. All righty. We're going to stop right there and I will see you in the next video.